Welcome to Wealth Coffee Chats, folks, for your daily live updates. Get the most out of today's episode by participating in the chat. Make sure you ask some questions, be part of the conversation, have a bit of fun, grab a coffee or a tea, take some notes, and get ready to start your day, folks. Quick few housekeeping rules, though. No spamming, no advertising or self-promotion in the chat. That's not on. Be kind and respectful to everyone when participating. And most of all, have a good time. Real estate investing can be your biggest asset. It also can be your most expensive asset when it comes to getting it right or getting it wrong, folks. It can be time-consuming, stressful, and that's why here at Positive, we have what's called a 6-star team, a full-service team that provides integrated wealth and property investing solutions and services simply designed to help you progress towards your goal of passive income through your property portfolio, folks. Make sure you check out our other podcasts on the Positive Mentor Network. Not only is there Wealth Coffee Chats, there's the Urban Property Investor. Drops every Wednesday with straight talking investing strategies and lessons with Sam Saggers. Property Investor Tales. This is where our clients, you guys, share real life stories from property investing, hosted by some of our advisors and strategists. And that's done every fortnight, dropping every Monday. Wealth, Wine and Wisdom, folks, that debriefs the week that was in the world of finance and property, hosted by yours truly, Jason Witten and Andy Fenton on Fridays. Welcome to another Wealth Coffee Chats. Marvellous Monday. Hope you're well, folks, wherever you are. If you think it's Get Rich Quick, you're in the wrong place. This is the wrong podcast. This is the wrong live for you. Welcome to another Wealth Coffee Chat. Hope you're all awesome and well.
Good morning, everybody. Welcome to another Friday edition of Wealth Coffee Chat, Finance Friday, as we call it. I always like to start with a joke on Friday. So today's joke is, where does Dracula store his money? In the blood bank. We've had some actually really exciting news this week. The Victorian state government has announced a stamp duty concession. Now, this is just a 1-year stimulus, and the goal is to slash the stamp duty on off-the-plan apartments, units, and townhouses. It was effective from the 21st of October, so earlier this week, and it's now available to all buyers, not just first home buyers, and at any price point. Just to note that house and land packages are not eligible for the stamp duty concession. And how it actually works is that the stamp duty is calculated on the value of the land prior to construction. So, for example, if you purchased a property in Victoria off the plan for $620,000 and the land was valued at $77,500, you would pay only $4,000 in stamp duty. So that actually means that you're saving $32,000, rather than the $32,000 you would normally paid. So we're actually saving $28,000 in stamp duty. So this is available for the next 12 months. So I think it's a great time to take a look at the Melbourne market and see if you could save quite a bit on this, the upfront cost of getting an off-the-plan property in Victoria. Today, I actually wanted to have a conversation about negative gearing. What is it, and how does it actually help investors reduce their taxes? I'll actually go through an example. Now, if you were earning $125,000, oh no, it's flipped. Just give me 1 second, everybody. Sorry for the technical difficulties. All right. So if we were earning $125,000, we would pay tax of $28,288. Okay. Now, this includes Medicare levy. Now, if you own an investment property and it earns an income of $25,000, and the running costs of the investment property is $35,000. This is interest, rates, etc. The investment property has made a loss of $10,000. So now your new taxable income is $115,000. And so the tax on this is $25,288. So you have saved $3,000 in tax through that investment property. Now, what you can do with that $3,000 that you've actually saved is you can receive that as a lump sum at the end of when you do your tax returns, and you can actually take that money and put that into your home loan, and as an additional payment into your home loan, and actually help reduce your bad debt by the tax savings. Alternatively, if you want to manage your cash flow better, you can actually talk to your accountants and request them to do a PAYG variation. What that means is the PAYG variation adjusts the tax you pay throughout the year, and so that actually helps with your personal cash flow. And so you're able to use negative gearing to be able to save on your taxes, and then use the money that you would have normally paid in taxes to help pay off your home loan. So that's actually how negative gearing works. Now, during this week, I've had a few conversations with clients, and there's been questions around whether you purchase a property under your personal name, or whether you purchase a property under a different entity, whether it's a company or a trust. Morning, Alyssa and Chris. I hope you're having a wonderful Friday. So in regards to purchasing it under a personal name or a trust, if you're purchasing a property under the trust, you don't have access to any of the negative gearing that I spoke about. So that could actually limit how much you can actually borrow. Now, on the flip side of that, there are lenders that I know who enable you to purchase properties under a trust. And once the trust is at a point where it is self-sustaining, which means the income is enough to cover all the expenses, then the lender no longer needs to see that debt and look at that entity and account for that debt under your personal name. Because in most cases, when you're purchasing under a trust, you're guaranteeing that loan as the trustee or the director of the corporate trustee. So that trust can get in a position where it is self-sufficient, which means the income that you would have used to ensure that the loan can be serviced can now actually be used for your next property. So this means that if it's done correctly, you can almost recycle your income, your personal income, to be able to purchase property through a trust. On the flip side of that, you will lose out on the negative gearing. The other con of purchasing it under a trust is that you don't have the same capital gains concessions once you sell the investment property as you would under your personal name. So it is worth weighing up the pros and cons in regards to the benefits now purchasing under your personal name, or the long-term potential benefits of purchasing it under a trust, and having the property in a separate entity can also potentially protect it from any risk of losing that property should you work in an industry where there's there's a high ability to be litigated. Okay, so that's all for today. I hope that everybody has a wonderful Friday and an amazing weekend. I look forward to catching up with you next Friday. Have a good weekend, guys.
Episode of Wealth Coffee Chat, folks. Make sure you like, subscribe, and turn on your notifications so you never miss a thing when we go live. Improve your portfolio and investing game, folks, with Wealth Coffee Chats live every morning at 8:10 each weekday. Make sure you join us. Previous episodes are also available wherever you get your podcasts, folks, as well as our other podcasts from the 6-Star team here at positivementor.com.au.